Good afternoon, and welcome to Techcombank's second quarter 2022 financial results presentation. We are pleased to report another strong quarter despite global macroeconomic headwinds replacing the fading pandemic difficulties. Execution of the bank's 5-year strategy remains well on track. Jens Lottner, CEO, and Alex Macaire, Group CFO, will share more details of the financial results and business updates with you, followed by a Q&A session. Jens and Alex will present in English with live Vietnamese translation available via a separate link. As usual, we will have another call in Vietnamese tomorrow for retail investors. We expect today's presentation and Q&A to last about 90 minutes. With that, I'll turn it over to Jens to begin the presentation.
Good afternoon, everyone, and thanks for joining and welcome to that second quarter analyst presentation. Again, what we will do is I'll quickly go through the highlights and then really give the floor to Alex Macaire, our CFO, to go into much more details regarding the numbers. So overall, as we have said, it's another pretty strong quarter. And we saw a good TOI growth and year-on-year, roughly 16.6%. And it was driven on both sides, and NII and as well as NFI. And again, there were some extraordinary effects given the fact that we had very strong recoveries, but overall, the main growth engines are pretty much intact. PBT went up quite a bit, again, driven mostly by the provision expenses and the recoveries. And return on assets still stands strong at 3.6%. And on the CASA ratio, we got a little bit of a drop, which were mostly coming in June, because a lot of our customers started investing into other asset classes, but also because of the tightening credit room across the entire banking industry. And there was repurposing of funds in order to make sure that business activities could just be continued. So again, and as credit was not available, people took some of their savings. So again, we expect that this will actually be coming back. But again, second quarter, we saw a tightening probably in line with the market. NPLs very much under control. And we see a continuous improvement in our asset quality. So again, I think we went through COVID pretty well. And as we had reported beforehand, we believe actually that the book is pretty much under control and that we are probably seeing one of the strongest books in the industry. CAR has improved, and some of that was as we were shifting towards retail and business in line with our strategy. And the RWA consumption started shifting. And again, I think that should actually put us in pretty good standing for some of the expansion strategies we are envisioning going forward. So overall, as I said, pretty much on track, strong results in line with what we had kind of guided beforehand. So let me hand it over to Alex to give you more of the details. Alex, over to you.
Thank you, Jens, and good afternoon, everyone. Let's take a look first at the macroeconomic context. So as you can see, Vietnam's economy continued to accelerate during the second quarter of the year. The GDP annual growth rate reached 7.7% during the second quarter and averaged 6.4% for the first 6 months, which is one of the highest rates in the world. Retail sales also gained momentum with an annual growth rate of 7.9% on average for the first 6 months, and even plus 24% for the month of June only. For the time being, inflation remains under control. That said, the strength of the rebound means that the Vietnam authorities are likely to take a more cautious policy stance going forward. Deposit rates have already gone up by around 10 to 30 basis points year to date in the market, and we expect that this trend could continue in the coming months. Let's look now at the financial highlights. So Jens mentioned some of them already. Overall, the bank continued to show strong momentum in the second quarter of the year. Both NFI and NII grew at a rate in excess of 25% over the first 6 months. We saw a lot of demand for our transaction investment services. Demand for credit was also high. As a result, our customers, particularly the most affluent ones, tended to keep less money in cash, driving our CASA ratio down a bit this quarter. However, having some volatility is normal, and as you know, our strategy is about the medium term and is about building the best digital bank in Vietnam. Therefore, we remain comfortable with our direction of travel, all the more so as we have a number of new propositions and products which are going to go live in the coming months. Turning to efficiency, it was good to see that our ROA, our ROE, our cost of income ratio, and our NIM all remain at the top end of their historic range, despite the higher interest rates. On risk, our NPL, as Jens mentioned, started to improve to 0.6% in line with the economic recovery. Meanwhile, our capital adequacy ratio also strengthened to 15.7%, up from 15.1% at the end of the previous quarter. In short, it was a strong quarter for the bank. We managed to largely dampen the impact of the rising rates on our margins, and we were able also to offset the headwinds from our trading income. However, the context will continue to be challenging, and we are adjusting our actions accordingly. Let's look at our PBT in more details. As I mentioned, strong performance on NII, plus 25% year-on-year, and NFI plus 29% year-on-year for the first 6 months. Our other income improved as well compared to Q1, although we continue to incur some losses on our government bond portfolio linked to the increased yields. As I mentioned during last quarter's presentation, some of these losses will be allowed to be reversed thanks to a new regulation passed by the government, and we will record the benefits in the upcoming quarters. On OPEX, we continue to invest in talent, marketing, and technology, and the year-on-year growth of plus 24% for H1 is in line with our strategic plan. Finally, our provision expenses were down very significantly, minus 56% compared to the prior year, which reflects the improved financial health of our customers. And all in all, we recorded a PBT of 7.3 trillion for Q2 and 14.1 trillion for the first 6 months of the year. This slide gives you more insight into the growth of our NII. As you can see, our interest earning assets grew 22% year-on-year and remained broadly flat quarter on quarter. Like other banks in Vietnam, we are now waiting for the regulator to communicate on the additional credit quota to the economy. In the meantime, we used the opportunity of the very strong demand for mortgages in the market in order to accelerate the diversification of our credit portfolio toward the retail segment. To do that, we essentially reinvested the credit quota freed up through the distribution of our corporate bonds. And as you can see, our portfolio of bonds decreased by 28 trillion quarter on quarter, and our customer loans increased by a similar amount. We have always been clear that we want to grow a stronger SME and retail business. These two businesses generate stable and capital-efficient revenue streams, and for these reasons, they also attract higher valuation multiples. And therefore, the fact that we are ahead of our plan to diversify our credit assets is good news. Regarding our funding, I explained the trend on CASA. As I said, we are very confident that the investments we are making in our products, propositions, and platform will drive increasing CASA market share. However, it is a medium-term game. Overall, asset yields, cost of funds, and LTM NIM all stayed broadly stable, with adverse movements limited to about 10 basis points on average. Let's look now at lending balances in a bit more details. So as I mentioned earlier, our retail exposures increased sharply during the second quarter, and our wholesale exposures reduced in parallel by a similar amount. It is once again the product of a conscious decision to accelerate the diversification of our credit portfolios toward the retail and SME segments. Yields on secured retail loans are usually lower than those on corporate loans, and this is why you can see that our credit yields edged down a bit this quarter. That said, capital requirements are also lower, which means that you can usually generate more profits with the same amount of capital. Overall, we believed that the shift toward retail will provide the bank with more diversified risk profile and a higher capital efficiency, therefore enhancing its intrinsic value. So these slides present a view of our credit exposures by sector and product. You can see on the left-hand side that our corporate exposures have reduced, and we expect that this trend will continue in the second half of the year as we expand further into the retail and SME businesses. On retail, our growth for mortgage and credit cards reached plus 65% year on year. It is a significant amount of growth, and importantly, it has been achieved without compromising on margins or compromising on cost of risk. Though it speaks positively, I think, about the strength of our customer franchise and also the strength of our underwriting processes. And with the investments we are making in loan origination systems and in the digitization of our front and back-end processes, we are confident that there is still ample space to continue to scale up our retail business. Now, a quick focus on deposits. A couple of points to highlight here. First, the fact that our average deposit rate increased marginally to 2.1% for the second quarter. As I mentioned earlier, we estimate that the term deposit rates in the market have increased between 10 and 30 basis points in the beginning of the year. And as you can see, the average impact on our own rates has been quite moderate. So there are a number of factors to explain that. First, our balanced pricing approach. Secondly, the strength of our CASA franchise, and then the optimization of our term funding structure. That said, we are clear about the fact that we see continued pressure in that space in the coming months. The second point to note is the reduction in our CASA deposits. As I noted earlier, we have seen some seasonality in the past, and it is to be expected. This year, the strength of the economic rebound, the pressure of the domestic consumption, the acceleration of the investment spend as reflected by the demand for credit, though all these factors have contributed to amplify the seasonality. As I said, we are watching this trend closely and will remain confident with the direction of travel. I would like to also look at our NFI in a bit more details. Overall, it's probably fair to say that the first 6 months of the year have been challenging. In Q1, if you remember, there was COVID wave 4, which impacted our banca sales. In Q2, there's been an adverse market sentiment, which has affected pretty much all bond-related activities. And therefore, in this context, the fact that we have been able to grow our NFI by plus 29% is, for me, testament to the strengths inherent in having a diversified business model. I will just mention a few highlights. So letters of credit were up plus 57%, and cash and settlement fees were up plus 147% year on year. We made a number of investments in those two areas, including digitizing our processes, rolling out a new corporate mobile banking app, and upgrading our trade services and working capital propositions. Cards were up plus 45% year on year. Our launch of instant credit card approval without document proved to be a game changer, and the customer satisfaction rate is as high as 97%. Banca was up 32% year on year and up 83% quarter on quarter. We saw a strong rebound after COVID wave 4, and we have continued to work with our partner Manulife in order to strengthen our underwriting and sales processes. And finally, IB fees grew 4% year on year and were slightly down quarter on quarter due to an adverse market sentiment largely linked to prospective changes in the regulatory environment for the bond market. That said, the need for bonds as a way to fund the economy and the investment vehicle for customers is not going to go away. It remains entirely there, and we are very confident with the perspective offered by this market in the medium term. Turning now to operating costs. So our level of expenses in Q2, as you can see, was broadly in line with the run rate for the last 3 quarters. Our cost-income ratio remained at around 30%, and the growth of our operating expenses for the first 6 months of 2022 reached around 24%. This level of growth is in line with our strategic plan and reflects the magnitude of our investment in digital data and talent. This quarter, we offered again a raft of new experiences to our customers, like automated bill payments through the mobile banking app, dynamic advice and nudges in-app through investment tracker and money tracker, a new mobile corporate banking app, and paperless credit account opening in less than 5 minutes. And there is much more to come. A quick focus now on asset quality metrics. As you can see, a good trend. Our credit cost remained at a very low level in Q2, 0.4 trillion or 0.4% of credit balances on a rolling 12 months basis. The NPL ratio was also down to 0.6% in Q2. Compared to 21, our provision expenses, I mentioned that earlier, decreased by as much as 56%. Overall, the financial health of our customers continued to improve in Q2, enabling us to reverse some of the provisions that we had booked in the previous quarters. And finally, at 172%, our loan coverage ratio is one of the highest in the industry and should provide further confidence in the strength of our balance sheet. Restructured loan balances declined sharply in Q2 to just 0.5 trillion or 0.1% of our total loan portfolios. It was good to see that most of our customers were able to exit the program or repay their loans. And it now seems that the end of our COVID support program is just around the corner after several months of working very closely with our customers in order to support them through those challenging times. We already touched on the resilience of our balance sheet. On capital, we added an additional 5.9 trillion to our equity. Our CAR improved to 15.7%, up from 15.1% at the end of the previous quarter, and our liquidity ratios remained comfortably below the regulatory limits. Finally, a glimpse into how our performance compared to peers in the first quarter. Overall, there wasn't much change, I would say. As you can see, our competitive advantage on CASA, on cost of funds, on NIM remained very significant. So let's look now at the full year 22 outlook and the GDP growth first. So as you can see, and as you know, Vietnam was one of the few countries which managed to continue to grow throughout the pandemic, and it's proved extremely resilient so far. What we see is that the inflation remains under control and there is positive outlook on domestic consumption, FDI, public spending, and tourism. We therefore maintain at this stage our forecast that the GDP growth rate could be in the range of 6.5 to 7% for the whole year. At the same time, we do not deny that there are still significant uncertainties in the global environment with the Russia-Ukraine conflict, with the higher inflation, and with the fears of recessions in the US and Europe, and therefore we remain cautious. This slide hasn't changed much since the last analyst presentation. Overall, credit growth is expected to significantly outpace deposit growth in 2022. The higher cost of imports should also translate into lower FX reserves. And overall, we expect the liquidity in the banking system to be tighter this year. And therefore, the increasing trend we've seen on interbank rate, on deposit rates, this increasing trend should continue in the coming months. So what does it mean for our guidance and the year ahead? So first, credit growth will be in line with the credit quota we will receive from the State Bank of Vietnam. The net interest margin has been relatively resilient so far, but we expect downward pressure, particularly coming from the price of deposits. Cost-income ratio could increase a bit as we continue to ramp up our investments. NII and NFI growth rates should moderate from the very high base reached in 2021. And as for NPL and credit costs, we expect that they will stay broadly in the same ballpark, which is a very low level compared to the Vietnam industry. So this concludes our presentation. Overall, the environment in the beginning of the year could have been easier, but we are satisfied with how the bank performed. The key points for me, beyond the transitory headwinds in our market activity, are the strong momentum in our core revenue engines, the high level of profitability, the improving cost of risk, and finally, and importantly, the accelerated shift of our credit exposure toward the retail segment, which carries the prospect of a more diversified risk profile going forward. So, in short, we are satisfied and happy that the bank is heading for us in the right direction and at the right pace. We will take a short break before resuming for the Q&A section. So thank you for having listened to us.
Thank you, Alex. We will now take a 10-minute break and return at 3:20 for the Q&A session. Please submit any additional questions to our IR team using the QR code or email address at the bottom of your screen. and it's a broad macroeconomic question. What is Techcombank's view on the potential recession in the US, slowdown in the EU, and China reopening in the second half of this year, particularly as we exit into fiscal year 2023? How will these assumptions affect Vietnam's economy, its banking sector, and Techcombank's prospects in the year 2023?
So thanks for the question. I think overall, these are indeed relatively strong headwinds. On the other hand, as Alex has shown, we're still seeing a 6 to 7% GDP growth at this point in time for Vietnam. So I think Vietnam is a little bit the lucky exception, and I think in terms of what's going on right now. And of course, there will be implications which we're seeing. Clearly, on some of the inflation in commodity prices, oil and steel, etc., will start having an impact. But on the other hand, again, we are not so much dependent like some of the other countries on some of these input prices. So even at a kind of $110 per barrel, and we probably still believe that headline inflation or CPI, given the constituents of the basket, will be rather at 2.5 to 4%. So we don't see that inflation probably will be coming in as a major dampener. I think there could be a transmission mechanism via exports. So if exports really taking a hit because of an import and reductions in or recession in parts of Europe or the US. But again, let's take a look into that. I'm not quite sure. There are definitely scenarios where the whole situation, Ukraine, Russia, and all of this could be going completely off the rail. But again, I think that's not what we're seeing. And then hopefully at one point in time, also China will be coming out of their kind of lockdown, which again should actually give positive impetus to export growth. So overall, we were actually saying we are still in a pretty good situation. We believe actually that the government has a lot of room to help maintain macroeconomic stability. I think we have a lot of still positive consumption growth. There's still a stimulus program they could activate. There are a lot of investments which are still out there. So again, I think a 6 to 7% growth trajectory for this year and potentially also for next year, I think is still in the cards. However, there will probably be some reluctance to go further, right? And increase potentially and put more kind of stimulus in or accelerate the situation or the pace of the expansion. What I mean with that is, will we do and see an expansion in credit growth? Will we see kind of that we're trying to really reduce interest rates, et cetera, which would spur more credit demand and therefore actually more investments, et cetera. So I think the central bank probably will be a little bit more cautious. And so again, I don't think that we will see a reduction of the numbers which SBV has announced in the beginning of the year, but I don't also think that we will see an expansion in the credit quota and for the industry compared to what SBV had communicated. So that means actually roughly credit will be in line with probably is right now priced in into the market. I think we will probably see that an interest rate will increase on both sides of the balance sheet, just because funding will be pretty tight, as Alexa said. But on the other hand, also, if the corporate bond markets are still not so easy to be accessed and capital balance sheet or banking balance sheets are kind of a little bit constrained, then ultimately rationing will happen through pricing. So again, I think overall for the banking industry, good and growth rates and should also help and on the NPL side, because a lot of companies should actually be able to get back on their feet and expand their business. So that should help also with some of the COVID recovery. Clearly, some areas will probably still be more affected, but overall, I think we are getting on a recovery path, which should actually be relatively stable and should provide, at least for the banking industry, a pretty healthy outlook for the next, I don't know, 12, 18 months. Again, barring any unforeseen developments which we could potentially have if some of the developments in Europe are really getting out of hand. But overall, I would expect that some of the macroeconomic factors which we described for the remainder of 2022 will also be somewhere the same like what we will see in 2023. And therefore, again, I think banks should, as a proxy to the overall economy, should actually faring pretty well.
Thanks, Jens. The next question is from Tao from BN Direct, and this follows up on what Jens talked about in terms of inflation. What are Techcombank's forecasts of inflation, both the headline CPI and core CPI? What are the key assumptions underlying that, e.g. oil prices, and what are the implications on liquidity, monetary and fiscal stance, including policy interest rates and effective interest rates? This question will go to Alex, please.
Yeah, so thank you, Tao. And I would agree that inflation is an important factor in the economic and monetary outlook for 2022. So to answer your question, our economic research currently estimates that inflation for 2022 should be around 3.5%. This is assuming a cost of oil of around $110. And this is also below the threshold from the SBV, which is around 4% for inflation. That said, as I mentioned during the presentation, we expect the liquidity in the banking system to be tighter in 2022. Several reasons for that. The fact that the credit will continue to grow faster than deposits, the lower FX inflows, so the fact that the liquid assets in the banking system are currently quite low, and overall a higher reliance on short-term funding, open market operations, and SBV swap facility for funding. So taking all that into account, our economic research estimates that the policy rates and the deposit rates could grow by around 50 basis points over the full year, maybe a bit more, and that the government bond yields could decrease by 130 basis points. That said, on the positive side, the recent upgrade of Vietnam by S&P also means that we can expect more interest from foreign investors in Vietnam, therefore, thereby easing up a bit the pressure on capital funding costs. And lastly, to your question about 2023, it's obviously a bit early to make reliable forecasts. All I can say that our economic research currently estimates that policy rates and deposit rates could continue to grow in a range of up to 50 basis points, maybe.
Thanks, Alex. The next question comes from Tuan at VCBF, Jun at MLAM, and Duc from Dragon. How does the bank see the real estate landscape in the remaining quarters of 2022 and next year, and how will that affect Techcombank's lending policies? I will ask Jens to answer this one, please.
Thanks. So overall, again, there's a lot of noise about real estate lending, etc. And so I think overall, and what you're seeing even or because of that, the SPB is probably acting accordingly. We still see a lot of demand for housing, right? So first one is there is actually still, and we said this again and again and again, there's still a secular trend that we need more housing, affordable housing, social housing, but also actually housing and at the higher end, and also as an investment class, and especially for mass affluent customers. So I think the demand is still there. We've seen, especially of course in very kind of prime areas, be it in Ho Chi Minh City, be it in Hanoi, pretty steep increases demand for that prime and estate is actually pretty high. And of course, that's where also a lot of developers are putting the efforts in. So a lot of the areas which were developed in Ho Chi Minh City and as well as in Hanoi are actually high-end and above, high-end apartments and above, actually not so much landed properties and only a few, and probably more in Hanoi. So overall, again, I think there's a lot of demand for housing, for real estate. And I think it's up to the industry to provide solid financing for these developments and for that sector. And I think that's exactly where the regulators came in and basically made sure, given the fact that it's such an important sector, let's just please make sure that we're developing it in a sustainable manner and that we're not trying to do any shortcuts or leading to land speculation, etc., which is actually not really ultimately leading to what we need, which is actually more housing units. So from our side, 98% we are actually in kind of not commercial real estate, but actually normal residential real estate. And a lot of our focus, kind of close to 100%, is actually Ho Chi Minh, is Hanoi, is high end. And so on that one, we actually feel very comfortable that we're in the right place. And we continue to do exactly what we've done in the past. We're focusing very much on high-class developers and good quality, and those which are able to have a very solid market position, provide really good products where there is a lot of demand. And if that's the case, then you see actually that the time from delivery to sales, cash flow, and project risk, etc., are very, very limited. And so that's what we actually continue to do. Again, and I think for 2023, as Alex has said, probably it's a little bit early. But again, I think what will still be true is that we will have demand for this asset class. And again, even if some of the prices have now started to be pretty high, we just need to assume that this demand is continuing, so that will still basically put some kind of pressure on the one hand on the pricing side, but on the other hand also on the financing side. And even if some of the financing will be a little bit harder to access, we still believe that I think it's actually a market where we'll still see growth, but again, I think probably in a little bit more controlled way. And again, if there are regulations like we need to kind of, for example, if you access capital markets, you need to publish more, you need to be a little bit more transparent in terms of what you need to do, etc. That's what we did all the time anyway. And so from that perspective, again, I think we are still very kind of comfortable that the way how we are running our real estate kind of portfolio on the corporate as well as on the retail side is actually very, very solid business, gives us very good risk and weighted assets, and that we will actually continue to expand that, but we're doing it very clearly in line with what the regulator is looking for, and doing it in a way that we optimize our risk and our returns on risk-weighted assets. So, and cut it short, and I think there will still be demand. I think it's okay to make sure that we do it in the right way, that some of the excesses in that sector are getting under control. I think it's okay to for having some of the players and just really taking a hard look. Do these kind of projects make sense? Are we making sure that we're not just speculating? Are we really creating housing units? Because that's what's required, and as long as that's happening, and we will clearly play a very active part in that part of the economy.
Thanks, Jens. The next question is for Alex. Could you share more details about the retail loan book and your outlook for the second half and fiscal year 2023? Specifically within the retail book, how is the split between primary versus secondary mortgages in the recent quarters and in the future in the upcoming quarters? And then following up on Jens, given that we are rotating the loan book from wholesale corporate loans and bonds to more mortgages on the retail side, what is the return on what is the difference in terms of return on risk-weighted assets of those two books? And this comes from Lon at Temasek and Kind from KIM.
And yeah, thank you for this question. And you have indeed correctly picked up one of the significant trends of our performance this quarter, which is the accelerated shift toward the retail business. So as I mentioned, and as Jens also explained, we expect that the growth of our mortgage and retail books will continue to outpace the growth of our other credit books in the second half of the year. There are several factors which allow us to predict that. First, the volume of units which will be made available in the market in the coming months, and then beyond that, the very strong demand for mortgages, as Jens mentioned. Regarding your question about the split between primary and secondary mortgages, you can essentially consider that the quarter-on-quarter growth in our mortgage balances was driven entirely by primary mortgages. Now, to your question about returns. So it's too early, clearly, to assess the full profitability of the new business we wrote in the second quarter, just because it takes time to cross-sell, to upsell, and to ultimately fully develop the relationship with our customers. That said, to keep things simple, both our wholesale RECOM books and our mortgage books, so these two books are both accretive to the bank's average return on capital. But the big difference, obviously, is that the retail books have the added benefit of bringing a higher risk diversification to the bank.
Thank you, Alex. The next question will be directed at Jens. Could you elaborate on the potential impact of the amended draft Circular 39, and how will this affect Techcombank's lending activities? This comes from Jung at VinaCap.
Sure. Thanks for the question. Again, I think whenever we have these drafts, we never know exactly and how it will end up, right? But let's, from the probably simplest perspective, I would say, and the idea is to kind of reduce, to a certain extent, the ability to do kind of financial leverage and at the same point in time, really be clear what is the purpose of the funds and you're taking up, right? And again, exactly kind of if it's for the right purposes and by all means, but if it's done a little bit in order to increase financial leverage, especially in certain parts, and then it's a little bit kind of making this more difficult. So therefore, by definition, you have kind of two sides of the equation, right? You have the ones where you're saying, oh, more lending customers because there is more kind of areas which are allowed banks that you can lend for these purposes. On the other hand, for those other purposes, there will be restrictions. So the question is, in what parts of the business have you worked? So again, I think there will probably in the short term, there will not be big impacts, but we could expect that especially in the real estate market, there would be some changes because some of that funding, again, we saw, and when it came to basically creating kind of stake transfer partnerships, replenishing capital and all of that, some of the leveraging, I think that's where it was a little bit originating from. And from our perspective is we always worked with very, very strong financial partners. So the kind of purposes or the questions right now have been raised for areas where you cannot or where we cannot actually extend credit in order to facilitate that. That was not probably things we were doing very much in the beginning, because we looked actually already from the beginning very thoroughly the financial and situation, health, and all of that. So if Circular 39 is basically looking for making sure that lender that we're not taking any kind of excessive risk, we're actually pretty okay. At the same point in time, we actually continuously enhanced our capabilities and in order to make sure that we can actually do and provide alternatives, right? And really listed bonds with clear transparency. Is there M&A opportunities on bridge loans and guarantees for international loans, etc., where we actually see that there is an expansion of the business opportunities. So from our perspective, again, we understand where the regulator is coming from, and we believe, again, we need to shift the business model somewhat, but overall, there will probably be ample opportunities also going forward. And as long as we're doing it and with the right measures, have the right capabilities, and especially the right risk management in place. So again, that is a comment on the current draft. Probably that draft will still undergo some changes, although we actually believe it will only be minor changes. But again, short term, not so much, and in the medium, probably to the longer term, we just need to adjust the business models, which are completely okay for us.
Great. The next question is also for Jens. Could you discuss the lower retail CASA that we saw in the quarter, and whether you see this as impacting management's longer term view about greater than 50% CASA ratio by the end of the year? This comes from JP Morgan and also Andrew from Halo Capital.
Sure, I think it's a good question, and we always kind of stress the fact that this is a very, very important ratio for us. So what we saw is actually until April, we got kind of a 7% increase in retail CASA. And then we saw kind of a change in May and in June, and actually to a certain extent, and that is a trend which probably a lot of other banks also have seen across the industry. And as I said, I think some of that were driven by the fact that there was a shift into other asset classes, right? Especially real estate, especially also still securities, especially on the real estate side, as people started accumulating funds and then started to deploy them and into these other asset classes. And so that basically brought the ratio down. And on the other hand, there was also, let's say, a little bit more on kind of businesses, smaller businesses who started using some of the kind of deposits and for financing the business as credit became tighter, right? So it's very clear as and it was a little bit harder to access funding and through the banks, there was just a tapping into your own liquid funds, and they were basically started redeployed into the business. So as I said, are we expecting that overall that the targets we have set will not be achievable? The answer is no. I think, and we made this point before, and there's a lot of reasons which are driving CASA. Some of that is really just the necessity for transactions. It's a question of what kind of solutions are you providing on the digital side, and how easy is it to transact, et cetera, et cetera. Also, what other asset classes you have, and because if, like on mortgage, like on securities, if you want to go in and out of these different asset classes, and sometimes the one or the others are more interesting, you start accumulating at a certain point in time, and then you start investing. Those who are divest will also have then suddenly liquidity available. So overall, as long as you are part of that overall value chain of investment and divestment, you will always have a certain amount of liquidity, which will actually stay with you. And given the fact that we have such a strong customer base, especially on the mass affluent, and also part of our wealth management strategy is to provide a wide range of products, so that this kind of parked liquidity will always stay with us and doesn't need to go out. So from that perspective, yes, we would like these numbers to go up, but with our investments, wealth management, our investments in SME, our investment in transaction banking capabilities, we expect this number to go up. But we should also be clear, competition will get stronger. And so we just need to make sure that we are shaping up our offerings. But there's no reason to assume that the target which we have set also within 2025 of the 55%, that we're not going after that, and that we're not achieving it, or even that at the end of the year, the number will be back to where we used to be at the end of last year, or even be higher. Again, some of that is also a little bit dependent on the overall liquidity situation and the liquidity management from SBB. So it's a bit hard to forecast exactly. But as I said, the secular trends and what we're trying to do, as well as the strategic importance, nothing has changed. So we see that as Alex has said, there's a volatility, and we're not managing these things quarter by quarter. We're just managing that, and overall the trend should be okay. And I think on that one, we're still okay.
Great. The next question is for Alex, and it relates to cost of funds and yields. Could you discuss the average rates for CASA, term deposits, and the cost of other sources of funds in the second quarter? And how did those change versus the first quarter and the same period last year? And then, as another follow-up on that is, why did asset yields decline when interest rates in general went up, seen by a higher cost of fund? And this comes from JP Morgan and Leon at New Silk Road.
Yeah, thank you for this opportunity to come back to our NIM, because it's probably of interest to a lot of us around this call. So as I mentioned during the presentation, our cost of funds for the second quarter was 2.3%, in the first quarter it was 2.2%, and in the second quarter of 2021 it was also 2.2%. So this gives you an idea of the impact of the increase in term deposit rates, interbank costs, and syndicated loan funding. So I also mentioned that the term deposit rates in the market had increased between 10 and 30 basis points year to date. And you can see in the presentation there is a chart on the variance of the interbank rate, and you can see that the growth year to date is around 60 basis points. So that hopefully will give you more context about what's happening in the market on the funding side, and also how it impacts our cost of funds. Now, when it comes to your question on credit yields, so essentially what we have done is that we have replaced long-term corporate bonds with primary mortgages, which typically yield a lower return, right? But at the same time, they also attract a much lower risk weight, and therefore you need to look at it from a full profitability perspective. And from this point of view, whether you look at the return on capital or whether you look at the risk profile of the bank, I think the shift toward retail segment and mortgages is a good thing for Techcombank, even if it comes at a cost of a slight decrease in the average credit yields.
Great. Thanks, Alex. The next question is for Jens. Could you please provide updates on the key digital and data initiatives in the second quarter? And again, what are the metrics that Techcombank uses to evaluate the digital transformation progress? This comes from Warwat at Credit Suisse and Cato from EFG.
Sure. Again, a lot of this we talked beforehand, but and let's be probably a little bit more specific what happened in the second quarter. So, and we are working on the key mobile banking platform. So, and they're in the market on the retail side as well as on the corporate banking side. On the retail side, and probably right now we have around 70% of our customers migrated. So we see actually pretty good uptake. The app is rated 4.7 out of 5, which makes it one of the highest rated apps in the market. There's a lot of new stuff on it, in terms of functionality. Probably it's by far the richest in the Vietnamese market. And again, we continuously bring new stuff on it. For us, the most important piece right now is now we start connecting actually intelligence into the app, meaning we can actually now start reaching out to our customers in a much more targeted manner, and giving them not just what to do and where to invest and what other business opportunities they have to invest their money and also interact more with the bank. So again, I think the front end right now is getting to a level of stability and reach, and which is where we want it to be. And now we really need to make sure that there's more intelligence coming out of and that app and out of that interaction. On the mobile banking side and on mobile corporate banking side, again, and we have re-platform. There's the new platform out. There's a new mobile app as well. And again, I think we're seeing pretty good uptick on that. So right now, when it comes to online term deposits transaction, and online term deposits are up 40%, transactions are up 20%. So again, I think we have not fully rolled it out yet, and that only comes at the end of the year with all the functionality and then uptick and upgrade. But again, I think it moves according to what we have in mind. On both sides on these areas, we have probably around 400, 500 people working on it. And so again, I think the idea is still over the next 12 to 18 months to make sure that we really start in creating more and more differentiation on that digital channel, and that we are also able to actually reach out to other customer groups and much more actively. At the same point in time, we're not just using it on, how should I say, in the on the kind of purely digital interface, but we also created a new portal for our employees, which allows them actually to take the branch outside. And that is a portal which actually is using the same technology platform, the same microservices, and start putting it on a tablet. And then that tablet allows us to go to malls, to micro marketing sites outside of the branches, and in order to make sure that we can still reach out to customers. Because probably like all the other banks as well, we've seen due to COVID a massive reduction in the branch traffic, and why we still believe that there is actually need for human interactions. But again, the question is, are we still doing it all in the branch, or are we having more options for people to go to? So that we took out. Right now we're having that tool within 3 to 5 minutes. We can open up a complete set of or a complete banking relationship with a set of different products. That has been rolled out to all the branches in the second quarter. And then in the second half, we will actually also make sure that credit card applications on it and customer information, etc. So we can do more and more things on that, which means we can actually provide these kind of services wherever it's convenient for the customer. And then last but not least, as we said, and it's not just about servicing and all of that, it's a lot about also giving the ability to purchase products online. So on the smart credit, which is this new capability where we start underwriting straight out of kind of systems which are backed by our own data, but also external data, and also kind of using machine learning algorithms in order to make sure that we constantly improve our underwriting precision. And so that smart credit system actually has worked pretty well. And we launched it kind of the next step in April 22. And so for that, right now in the second quarter, and we, for example, saw an improvement in terms of credit cards opened by around 140%. So again, whenever we have these capabilities right now out there, we actually see that we see not just incremental change, but 5 to 7 times more applications, 5 to 7 times more interaction, etc. So we really believe we're actually on the right track. Now, when it comes to the kind of how do we measure results, right? And some of that, of course, is a little bit, how to say, more difficult to say, because some of that only comes at the end, right? If you're saying, okay, how many more credit cards do I see, and how many more credit cards do I issue? And that's a little bit like a lagging indicator, right? So for us, it's a lot about, are we reducing onboarding time, right? And how often do really our customers interact with us? What is the kind of download rate, and etc. So what's some of the NPS scores? Because then ultimately the rest will just follow, right? So we look actually into customer engagement data, customer behavior, and then really pure kind of operating metrics, financial results. And again, in terms of the engagement, probably it's rather how easy is it to use the mobile and banking app? What's the feedback on that? On behaviors, how many customers do we have on the e-channels? How often are they using it, right? What's the number of online transactions? And how much are we acquiring through the digital channels, right? So how many customers are joining us through an eKYC process? And then in the last one, when we look through operating metrics, it's really conversion rates, number of CASA accounts, number of term deposits, and average balances, etc. So these are the kind of things which we're measuring quite religiously. And again, some of them, as you would expect, there's a good mix of colors. A lot of them are actually green, and there are some orange, but sometimes there are also some reds. But for us, the most important piece is that we understand the reds as quickly as possible, and why is it red and not according to our expectations. And then, is there something we can do, or did we have certain assumptions just not correct and therefore need to adjust? But again, I think overall, and at least after we had some of these stability issues, which I commented in the last quarter, I think we're actually on a pretty good track and to start and seeing an acceleration of our digital capabilities, and therefore also our digital outreach to customers and our ability to bank new customers and put new customers onto our platform.
Great, thanks, Jens. Thanks for all the questions that are coming in. We're combining them, and in the interest of time, we're just as a time check, we're going to try to end the Q&A at 4:30. So bear with us. The next question is on foreign exchange and interest hedging, and this is directed towards Alex. What is your, given the recent announcement of successful syndicated loan and the one that you did last year, what is your USD and other foreign currency denominated liability at the end of the second quarter? How much was the syndicated loan as the part of the total? And how do you hedge for FX, and how do you hedge for increases in interest rates, given that SOFR and LIBOR have been moving up recently? This comes from Twin at VCBF and Warwat at Credit Suisse.
Yeah, thanks for this, and let me elaborate a bit on our FX exposure. So overall, we have around 100 trillion dong of foreign denominated liabilities. Those liabilities include our syndicated loans and are mostly in US dollar. And against these liabilities, we have 90 trillion dong of foreign denominated assets, which again are mostly in US dollars and provide a natural hedge. Therefore, what we have left with is a net short position of around 10 trillion dong, which is fully hedged via FX swaps. Therefore, our residual FX exposure is practically negligible. Now, regarding the question around the impact of rising interest rates, so as I mentioned, we have a natural hedge between our assets and liabilities in US dollars. And as for the residual exposure, it is essentially aggregated with our other interest rate exposure and managed holistically via our ALM, where we would look at various indicators of exposure to interest rates. And then I think there was a question also about the level of the interest rate and the cost, therefore, of the wholesale funding and whether it's still a competitive advantage. Our view is that it is still a competitive advantage, because it would be very difficult for Techcombank and actually for any bank to raise medium to long-term funding in the domestic markets for this kind of size. And even if we were able to do that, it would come at a significantly higher price. So I hope this gives you a broad understanding of how we think of our FX exposure, how we manage them, and what is the cost of funding and the implications of raising funding overseas.
Thanks, Alex. Next question is for Jens. When do you expect to receive a new credit quota for this year? And you touched on the credit growth quota of 15% for the minimum 15% for the credit growth for the year. How do you handicap, the odds of it being less than 15%? This is from Duc at Dragon.
So thanks for the question. Again, as we said, some of that we really don't know, because I think right now, and given all the uncertainties, SBB is probably also looking at all the macroeconomic factors and think about where is inflation heading, where is GDP heading, etc. And I would expect probably somewhere in August that we will get indication of where we're heading. We know that probably overall the banking industry is pretty much maxed out in terms of when it comes to kind of bank balance sheet. And so again, at this point in time, probably everyone is already holding a little bit back. So by August, probably there will be something coming out. But again, I think that's really SBB's prerogative. The question is, are we still maintaining the 15% planning scenario? Yes, we do. And we believe, given the fact what we've done in the past, our performance, our capital, etc., when it comes to that, we should be granted these kind of quota, given the fact that we're actually still a very important credit provider and to the industry and supporting customers and the economy. So again, I think the ball is probably pretty much in SBB's court, but again, at this point in time, we're still maintaining our 15% planning scenario.
Okay, thanks, Jens. The next question is for Alex. Could you comment on other investment banking services and overall TCBS performance in the second quarter? Was it in line with your internal target and guidance? What is your second half outlook, and what are the drivers? And related to that is it looks like TCBS market share gain were slower into second quarter, and then how do you see the 2% additional market share gain per annum in the 2022 to 2025 period target that had been discussed before? This comes from Pon at Van Campernoll Asset Management.
Yeah, thank you, and I appreciate your interest in TCBS, which is a key component of our businesses. So to answer your first question, yes, the performance of TCBS and investment banking more generally in the first half of the year and in the second quarter more specifically was in line with broadly with our internal targets. Regarding the second half of the year, so we expect some improvements driven by more liquidity in the origination and distribution of bonds. Now with your second question around whether we maintain our objective to grow our market share on equity trading by 2% per annum in the period between 2022 and 2025. Yes, for the time being, we stick with this objective. There are a few reasons to believe in our capacity to continue to grow our market share. The fact that we will launch new partnerships with institutional customers, the fact that we will enhance the features of our mobile trading app, the fact also that we will work on the opening of accounts digitally, thereby driving more new customers to our platforms. And also more generally, the fact that we will keep putting out in the market innovative products and propositions. To give you a few examples, so we launched iCopy, which is essentially a new proposition by which retail investors have the opportunity to copy or replicate the investment strategy of successful traders. And this helped drive up the traffic on our platforms very significantly. We were also the first in Vietnam to use blockchain in order to secure the transactions on our bond trading platforms, and there is much more to come. So overall, we are very confident in our capacity to continue to grow our sources of earnings and investment banking beyond bonds, and and increase our market share on equities by around 2 percentage points per year.
Thanks, Alex. The next question is also for you. Have you reversed the first quarter provision made for the government bonds in the second quarter? This comes from Tang at Maybank.
Yeah, very, very good question, and the answer will be short and no. So Tang, essentially you can assume that the benefit of reversing these unrealized losses will be recorded in the upcoming quarters.
Thank you. Why don't you take the next question as well? Could you share more details about NPL and provision for both corporate loans and bonds, recoveries and credit costs in the second half of 2022 and 2023, what your expectations are? This comes from Alex at Fiera Capital.
Yeah, thank you, Alex, for this question and your interest in our credit portfolio. So some details, additional details here. So as I mentioned during the presentation, our NPL improved in Q2 to 0.6%. It was 0.9% for retail customers and 0.3% for corporate customers. Our credit cost on the last 12 months basis was just 0.4%. So overall, we expect these indicators to remain in the same ballpark in the second half of the year. We can see that there is a good cure of our portfolios under the COVID restructuring program, and there is also active diversification from wholesale toward retail. So in short, a stable outlook for both provisions and delinquency. Now, as for recoveries, they are very difficult to forecast. That said, I would say that I would expect the amount of recoveries in the second half of the year to moderate a bit compared to the very significant amount we were able to collect and record in the first half of the year. So I hope this answers your questions. If you have want further details, feel free to get back to us.
Thanks. And the next question is for Jens. In the stress tests that the bank runs, how much of the credit balance exposed to real estate sector could turn into bad debts? This comes from Joe at BitCap.
So, how should I say? I think from all what we're seeing is that in the stress tests, given the fact how we are lending, given our kind of LTV ratios, which are pretty conservative, and given the fact how the real estate prices actually have developed, which again also helps the LTV. If we look at the service coverage ratios, how are our customers funding and the assets, etc. Frankly, we need to find very, very unrealistic and implausible scenarios to stress our book anywhere close to where we would get to the regulatory minimum capital. And so again, the overall real estate exposure, because that's what we are describing. But again, I think the overall quality of the book and what we're seeing is actually very, very low. So therefore, again, I'm a little bit trying to try a way to basically saying what exactly are the outcomes of the stress tests. But again, I can actually really assure everyone on the call that whatever scenarios you're running, it will not make any material dent into our profitability or our capital position, just by the pure fact of how we're financing our book, the average duration, the quality of the lenders on the retail as well as on the institutional side. So there is no no major exposure and kind of loss given default. And whenever we are stressing our portfolio under ICAT rules, and either the regulatory scenarios or our own scenarios, which are even more stringent.
Thank you, Jens. Let's take one more question, and this one goes to Alex. Alex, could you share the latest updates about the amended draft for Decree 153 and how this will affect the bond-related activities and fees for Techcombank? How did this affect us in the second quarter? And what has been done to prepare for the impact going forward in terms of underwriting volume and margin of underwriting, and then its impact on distribution as well? This comes from Lynn at Endurance and Tang from Curriculum.
Yeah, very good question, and I would agree that this draft Decree 153 has been an important driver and an important development as well in the latest quarter, explaining a lot of the trend we've seen in the bond market. So what we can see that the latest draft, which has been recently presented to the government for comment, achieves a better balance between the long-term development of the bond market and the short-term impacts. I think it also recognizes the need and the importance of bonds as a way to finance the economy and also as an investment vehicle for market participants. In the short term, we expect that the market will continue to remain soft for both distribution and origination. And this just because we need time for the rules to be finalized and for the issuers and investors to adjust their anticipations. We, however, expect some recovery toward the end of the year, and 2023 should be better than 2022, although it remains to be seen whether it will be as strong as 2021. Though to put things in perspective, between 2019 and 2021, the market grew for origination, bond origination, grew at a rate between 40% and 60% per year. And then in the first months of the year, the market essentially went back to a level which is broadly in line or below 2019. So it is a very significant drop. And then when it comes to how it impacted us, so I mentioned during the presentation that our investment banking fees grew actually year on year by around 4% year to date compared to the same period of last year. So there are two reasons for that, or two conclusions we can draw from this trend. The first one is that Techcombank has suffered comparatively less than other market players from the adverse market sentiment. We estimate that our market share over the period has more than doubled versus 2021 and has reached probably something like 35% over the first 6 months of the year on bond origination. And then the second conclusion I would be tempted to draw is that our investment banking business model is now much more diversified thanks to the market share gains we have made on our equity trading platform. And as a result of that, we are less and less reliant on bonds in order to drive our investment banking results. But then again, when you look at the bond market with a medium-term perspective, then you see a lot of potential for this market to continue to grow. It offers investors a potential to grow their wealth with a predictable rate. And my personal assessment is that at around 8%, the average yield on bonds in Vietnam are quite high and attractive when you compare them with the tenor, which is typically less than 3 years, and when you compare it with the underlying credit risk, at least for those bonds that we issue.
Thank you, Alex. This concludes the second quarter 2022 financial results presentation. The presentation and replay link will be posted on the investor relations section of the website soon. Please continue to contact the IR team at ir.techcombank.com.vn for any additional questions. We look forward to speaking to you again in 3 months. Good afternoon.